Supply and demand. Probably the most important thing you need to know in trading in order to become a profitable trader. In this video, we will cover topics like what is the supply, what is demand, how to identify each of them, how to use them, and as well as fundamentals that many traders don't know about. So if that's something you're interested in, kindly leave a like, a subscribe, and most important, give us feedback in comments. Now let's get started. Alright, so we should get started with an introduction to the supply and demand to understand some fundamental knowledge of what it is. So what is supply and demand? Supply and demand. It's a fundamental law of economics. It's what moves the market. Not only the financial market like the FOREX and stocks, but it moves every market like the food market, the job market, and so on. What happens is when demand is higher than the supply, the price of that product in that certain market increases. Why? Because more people look to buy and the producer or market makers increase the price to increase their profit. Now the opposite happens. When supply is higher than the demand, the price of a product in a certain market will decrease. A reason is because people abstain from buying, usually because the price got high enough that they don't see it being worth buying. The market constantly changes its state and price moves between these economic fundamentals. However, on the chart, the supply is also defined as an overbought situation, and the demand is seen as an oversold situation. The price constantly gravitates between these zones, and it is our goal to identify the zones or areas where price will be oversold to buy it or overbought to sell it. So it follows the basic premise of trading: buy low, sell high. You probably heard that one before. And the way we can do this is by using the supply and demand zones. Knowing price moves in cycles. There are few theories on market cycles like the Wyckoff price cycle. So the market state is in an accumulation during the oversold zone. Accumulation meaning market participants. So traders are loading up orders. Accumulation is often used when price consolidates before a push to the upside. Then demand becomes higher than the supply, which causes the price go increase, up until the distribution area where supply and demand is in a state of short-term equilibrium, usually in the distribution areas. Smart money traders distribute their profits by closing their buy orders, which causes a slight downside that encourages other traders to start selling the market, and supply becomes higher than demand, causing the price to decrease. Let's say a market maker or a bank wants to buy here. Since these smart money traders with large orders open a position, the opposite position must be sold to them for their trade to be opened. So what I mean is, imagine if the banks wants to buy 100 shares or lots, they need 100 lots or shares to be sold to, and that liquidity is often taken from retail traders, stop losses. Let's see the psychology and how this market moves in cycles of supply and demand. So to get that liquidity, they start opening orders and creating patterns to potentially deceive the retail trader. So look at this for example. A double top has been created. A lot of sellers entered positions with their stop losses right above. Here we have a double bottom, so that is the opposite of the double top. And the double bottom influences traders to buy long with their stop losses sitting right below the double bottom. And we know that when a buy order gets stopped out, that order was sold into the market. So what usually happens is price consolidates or accumulates between two zones, with their goal potentially being gathering liquidity from traders to use that to fill their large orders. This move is a fake out, also called as a fake move because its intent is to liquidate the stop losses, in this case of the buyers. So traders that bought the double bottom have been stopped out. Right here, people often confuse it as it being a lower low, so they just sell short it, but they probably didn't know that the obvious patterns that the market has created has influenced traders into selling the market. So there is a lot of liquidity from sellers. So what does price do? Aggressively push to the upside, liquidating the traders that have shorted this zone, and the double top. You need to pay attention to the fake move, because in order for them to create this move, they sold into the market, so they are running the position in drawdown, in negative, the position being in an unrealized loss. So what often happens is when price starts hitting some equilibrium and kind of balances out, the process starts repeating. Double top, that leaves liquidity. Here too, so there is a lot of sellers' liquidity. Here double bottom with buyers, stop losses probably below. Then the fake move starts again. That liquidates the sellers, then the buyers. Then equal highs and equal lows, leaving liquidity above and below. So what does it happen? The fake move takes the liquidity of one or both sides. Usually the reversal or true move happens when the price hits their entry level on the position used to manipulate the price. So in this case, the manipulative move was this push to the downside. And how can we identify such moves? These types of price action leave clues behind like an order block, a demand area, a supply area, a fair value gap, and so on which smart traders can use to their advantage to follow the large institutional traders. So after price liquidates both sides, they take the price into this demand area, where they close the sell short and break even, and they open another large buy, which causes the price to break above and start an aggressive uptrend, using the stop losses of the sellers to take their liquidity and drive the price into their advantage. Them buying, obviously, the best market movement is to the upside. So our goal is to identify these zones in which we can look for entry opportunities to buy or sell the market. So this is the basic supply and demand concept, where you usually have an accumulation, a manipulation, an initiation, then price comes back to mitigate the zone, then the market often goes into the macro direction. The next concept is the continuation supply and demand theory. This movement simplified is basically just rally, base and rally again. And for the bearish scenario, it's the drop, base and drop again. So this often happens after the basic supply and demand theory. Notice how this is the continuation of the previous price action. So this impulsive move is actually the last bullish impulsive move from the previous price action. So after that, price pulls back and creates some form of retail trading pattern, in where many traders start buying and selling, and we know psychologically they place their stop losses above and below structural areas, like the lows and highs of their retail trading pattern that they trade. So what does the market do? Smart money start launching a fake move that stops out the buyers and uses their liquidity to buy another batch of buy orders. Because remember, smart money need to open orders in batches. They can't just open a 1 million lot or shares trade, that simple. They need 1 million of the opposite trade to sell to them, for them to be able to execute that trade. So what they usually do is open small, multiple batches of trades. So after pushing the price into their main order, which on an uptrend they usually run buy orders, they liquidate the stop losses of the sellers also. Then they return the price back into the fake move, which we can spot by a smart money structure, on which they close the fake move order into break even, and the process repeats over and over again until the trend exhausts, and there is no more significant liquidity to take. So this is why it is called a rally base rally. Now in the bearish scenario, it happens quite the opposite. The same psychology and price action, it's just the opposite. So we got the drop, the accumulation named as a base, where the fake move usually happens, then the drop again, price coming back into the supply zone for market makers to close their fake buys that cause the fake move upside. So price mitigates that supply area afterwards and breaks down the lows. So let's look in a chart. Let's say that smart money wants to buy a large order here at the lowest level. So price sets a high after and breaks down the lows. That move to the downside was the fake move. Why? Because we know right below the lows stand a lot of stop losses of the buyers. For this move to be created, the smart money opened sell short positions, and they put themselves in drawdown. Here it is. The first clue that this market is going to reverse. This candle's psychology suggests that sellers were winning up until a point where a large number of buy orders took control of that candle, so the market goes up. The second reversal clue is the break of the minor structural high, and the confirmation of the reversal happens when price takes down the stop losses of the sellers by liquidating the previous highs. An uptrend is followed by structure breaks, so highs being constantly broken. Then price creates some sort of double top, so a bearish pattern where a lot of selling liquidity has been accumulated above the highs. Price eventually coming back to hit the demand area where smart money usually closed their fake move, which was sell, in break even. A sell order is countered by a buy order, so price shoots up after smart money exit their sells. If we move to a lower time frame, we can look for the reversal for a potential trade. In this case, right after the reversal candle, this was a great buying opportunity with a stop loss below the lowest point hit in the demand area and the final take profit above the double top pattern. Knowing sellers' stop losses could get liquidated. This is an almost 6 risk to reward trade, but in reality it's smaller because we take partial profits. So like a percentage of profits at 1 to 2 risk to reward, then another percentage at 1 to 3, and so on. And on the large time frame, the gray area is the larger demand area, See that it hits and moves to the upside here, 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 and here. And the red demand area is the demand area inside the lower time frame of the macro demand zone. Another example, the market forms this small trend line. Knowing traders buy the support of it, we need to know that they probably have their stop losses below the support of the trend line. So what to the market does? Break down to accumulate liquidity. This is a broken down demand area. So if it is broken, it becomes a supply zone in which we can see price rejects down on multiple touches of the zone. So price enters an accumulation or stagnation in price. We mark the highs of the consolidation, which is this, and the low, which is this one. We can also see another formation of an ascending trend line, and exactly like the previous one, with standing stop loss orders from the buyers below it. So price breaks up the high of the accumulation, they choose to liquidate the sellers first. But knowing we are in a downtrend, we should carefully look at the macro trend. We see no significant signs of a reversal. So we take into consideration that this is the fake move, and we mark it as a supply area from the start of the candle that liquidated the seller's stop losses to the high of the structure. Then we can easily see how price gravitates between liquidity by breaking the ascending trend line, breaking the lows of the consolidation. Why? Because there sit a lot of liquidity. Price eventually coming back to retest the supply zone, so smart money can close their buy orders that probably created the fake move. Now price hasn't broken a structure yet, but a probable move is taking the stop losses of the buyers and reversing to an uptrend afterwards to take down sellers that time. This is very important to know, the fact that price gravitates and moves towards liquidity. For the entry strategy, there are multiple options. The first step is switching to a lower time frame to see how price reacts at the supply zone. So a good shorting opportunity is after the down reversal candle closes. The take profit is taken in partials. The first take profit I would take is right below this zone, knowing there is some liquidity of the buyers from their stop losses. The second take profit, so the other 50% batch, I would take below the lowest low, so right here. Why? Same thinking. Stop losses gathered below. And for the stop loss, there are also multiple options. Above the gray zone, so that is the macro supply, above the last low, which is a riskier placement, and above the red zone, which is the supply created by the fake move. This is up to you. All right, thank you for watching.